Alright, with this, I want to look at this dividend worksheet, and it's going to go through a lot of the problems that you have to work and how you're going to work them for this dividend chapter. With this, we have a couple of things we have to do. One thing that has to be done is we need to be able to record the entries whenever we declare a dividend. And what we're looking at here is a cash dividend. So we are looking at actually the journal entries that are required for the cash dividend. What we have to do first is we have to figure out how much the dividend is. It tells us that we have declared a 10 cents cash dividend on 10,000 outstanding shares. So if we had 10,000 shares, each of those shares got 10 cents. What that means is we are actually going to be paying out $1,000. There are 3 dates that we have to deal with when we declare a dividend. The first one, it happens actually when the board of directors actually declares this dividend, and that is the date of declaration. On the date of declaration, we have to prepare a journal entry that looks at this liability, because as soon as it's declared, we now have a liability. And so the journal entry that you would have, we would do it into the dividend account. Some textbooks say cash dividends, some textbooks just say dividends, so it just really depends on the textbook that you're using. And then the company that you're working for is going to depend on what their chart of accounts has in it. So this would be a dividend. It is for $1,000. And the other side is going to be that payable account. So you would have a dividend payable because we do owe this money to our stockholders as soon as it is declared. And that will be for the $1,000. The next date that we look at is the date of record. Now the date of record we've discussed already, that is just where we decide who is actually going to receive that dividend. So we pick a date and we say, okay, whoever owns the stock on this date is the one that's going to actually receive the cash. We have to do this because stock is bought and sold constantly on the stock market. And so between the date of declaration and the date of payment, different people may own that stock. So we come up with this date of record. This is where we find out who we're actually going to be paying the money to. There is actually no entry for this. So when you're taking a test or you're doing something else, I want you to write that down. You need to write down no entry on that date of record. And that's worth a few free points for you as far as the test goes by just putting that no entry down. Because we don't have an entry on that date, that's just we're looking to see who actually owns it. Now, when we actually pay it, we're going to be paying cash out. So, is cash involved in this entry? The answer there was yes. What's happening to my cash? Well, it's going down. So, if cash goes down, that's going to be on the bottom because cash is going to be my credit. So, what I'm doing is I'm paying this dividend payable. So, dividend payable will be my debit account. Cash is my credit account, and that'll be for those $1,000 amounts. And so this is what we're going to look at when we have to prepare those journal entries for a cash dividend. Now, there are other types of dividends, and one being the stock dividend. Now, with the stock dividend, on your worksheet, you'll see that on June 15th, the company's board of directors declared a 10% stock dividend to be distributed on July 30th to the stockholders on record on July 3rd. The company had 200,000 shares of $1 par value stock outstanding with a market value of $20. And so it wants us to prepare the journal entries. Well, the first thing that we need to look at is we need to know how many shares are we actually going to be issuing out. So we'll take the number of outstanding shares, which at this time is 200,000 shares. We're going to take 10% of those shares. 10% of those shares is equal to 20,000 shares. So we know that we are going to be distributing 20,000 shares of our stock. The second thing that we need to do is we need to place a valuation on these shares. And we're going to do it pretty much the same way that we did when we issued shares initially. So we would take the 20,000 shares. We're going to take what the market value is for those shares, because that's that going price. That's what they would be sold for if they were sold in the market. So we take the market value of $20, and this is going to give us $400,000. The next thing we need to look at is, what is their par value? Well, the par value of the stock was $1. So that is $20,000. And this is going to give us an excess of $380,000. So what we can do with this information is we now can go in and prepare those journal entries. And so when we do go in and prepare this journal entry, what we will find is, and I'm going to switch to the next page to kind of look at this, what we're going to see is that we still are going to have on this date of declaration, so we will have those 3 dates as well for stock entries. The date of declaration was June 15th. So we would have June 15th. It is a dividend. Some textbooks do have stock dividend as the title. Some just have dividends. So it is a dividend. And we are issuing out the stock. Now the dividend is going to be for that $400,000. We're not issuing the stock today, so we're going to have a new account called Common Stock Distributable, because we haven't distributed it yet. So once we distribute it, it becomes common stock. But right now it's just Common Stock Distributable. It's kind of like a payable account if it was something dealing with cash. But since it's common stock that we're actually going to be issuing out, it'd be Common Stock Distributable. And that is going to be for the 20,000. So just like what we saw in our issuance journal entries. And then we're going to have the paid-in capital par. And remember, that's the paid-in capital in excess of par for common stock at $380,000. So that would be the journal entry that we would have on the date of declaration. Now, the date of record, it says, was July the 3rd. On that date of record, there is no entry. We're just trying to decide who is actually going to receive these stock dividends. And then we get to July 30th, and this is actually when we're going to issue the stock. So, this is that date of payment. And so this is when we actually issue the stock out. So we're going to take it out of Common Stock Distributable, and it will become part of that common stock because it has now been distributed. It's been issued. And so these would be the journal entries that you would see whenever we are looking at, and remember, this is a stock dividend. So those would be the journal entries for a stock dividend. Now these are the entries that you would see for a small stock dividend. And remember, a small stock dividend is anything 20 to 25% or below. And since this was a 10%, it would fall underneath that small stock dividend. And these would be the journal entries that you would see under a small stock dividend. The next one that we will look at are stock splits. So it says ABC had a 2-for-1 stock split. Outstanding shares before the split were 10,000 shares with a $2 par value, and they had a $20 market value. So what would the resulting amounts be after the split? What we have to do with a stock split, if you remember in our earlier lecture, we said that it would increase the number of shares. And so what it's going to do is you are going to take, in this case it's a 2-for-1 stock split, So you would take the 10,000 shares, you'd multiply it by the 2, and that would give you the 20,000 shares is what would now be outstanding after the split took place. We not only have to look at increasing those shares, but we have to decrease the par value because we had a $2 par value. Well, once we have a stock split of the 2, we have to reduce that down, so now it will be a $1 par value. And the other thing that changes is that market value. So if we had a $20 market value, we would divide that by, and remember that is by that split number, that 2, and so now we would have a $10 market value. Now what you'll notice with this is we started out with 10,000 shares at a $2 par value. Well, that's $20,000. When we ended, we had 20,000 shares at the $1 par value. So it's still at that constant price of that $20,000. So the overall amount doesn't change. It's just how we are valuing those amounts that actually changes. The next one I'll look at is the earnings per share. And this one, LOP Inc. has a net income of $110,000. There were 190,000 shares outstanding at the beginning of the year. At the end of the year, there were 210,000 shares outstanding. There were 1,000 shares of $100 par value, 2% preferred stock outstanding during the year, and it wants us to determine the basic earning per share. The first thing I want to look at here is how we figure out what a preferred stock dividend is going to be. So, when we're looking at a preferred stock dividend, we are going to take the number of shares. You will multiply that by the par value, and then multiply that by the percentage. And this is going to give us what the dividend is going to be. So in this case, I would take 1,000 shares, $100 par, 2%. And so what we would end up with for our preferred stock dividend would be $2,000. Now you're going to have to use this equation in figuring out earnings per share. You also will have to use this equation when we try to figure out how much our preferred stockholders are going to get, which is the next question on the worksheet. So that's what we do to figure out those preferred stock dividends. Now the other information that we have to know for earnings per share, we need to know the net income, which we know is 110. We also need to know what the average common stock is. The way we find average common stock is we take the outstanding shares at the beginning of the year, the outstanding shares at the end of the year, and we take an average of those two. So in finding the average common stock, we are going to take the beginning of the year shares at 190,000. We will add it to the end of the year shares, which was 110. Divide that by 2 because it is an average and we have 2 items, and that is going to give us 200,000 shares. We then can look at the earnings per share formula, and the basic earnings per share formula is looking at net income minus that preferred stock dividend divided by those average common stock. So if we go back and we look at the worksheet, what we'll find is that our net income was $110,000. We just found that preferred stock dividend to be $2,000, and we found that our average common stock was $200,000. So when I look at all of this math, I get 108 over 200, and that is going to give me 54 cents. So my earnings per share is going to be 54 cents. And now realize that is per share. So it's 54 cents per share is what I'm going to be looking at with my earnings per share. So that would be how I would calculate that. The last one that I'm going to look at as far as the worksheet goes is dividing our dividends that have been declared between what we owe to our preferred stockholders and what we owe to our common stockholders. So here we have Cars Inc. Has 3,000 shares of $100 par value 10% preferred stock and 10,000 shares of $10 par value common stock outstanding. It has declared and paid cash dividends each year as shown below, which is year 1 is 15,000, year 2 is 40,000, year 3 is 80,000. So the first thing that I have to do is I need to calculate how much are my preferred stockholders owed. So what is that preferred stockholder dividend? Now remember, I told you in the last problem, we were going to take the number of shares, multiply that by the par value, multiply that by that percentage. And so what we end up with here is that they are supposed to receive $30,000 a year. Now in looking at this, what we have is year 1 is at 15,000. We have year 2 at that 40,000. And we have year 3 at the 80,000. Now we have to break out what our preferred stockholders are going to be paid versus what our common stockholders are going to be paid. Now remember, our preferred stockholders get their dividends first. So they get what they are owed first. Now we have two types. The first type that we're going to look at is the cumulative dividend. And with the cumulative dividend, what this means is if they don't get it paid in that first year, then it accumulates and they get paid that amount that they were owed in the second year. So what we have to look at is, in the first year we're paying $15,000 in dividends out, but our preferred stockholders are owed, and the amount they are due is $30,000. But we don't have $30,000 that we declared. We only declared $15,000. So that means that our preferred stockholders are going to get that full $15,000. And our common stockholders will not get any money at all in year 1. So then we get to the next year. Well, we still owe these guys $15,000 from year 1, and then we get year 2 comes along. And when year 2 comes along, well, we owe them another $30,000. So we actually owe these guys $45,000. Well, of that $45,000, how much are we declaring this year? Well, $40,000. So we can only pay out $40,000 this year. So they're going to get the full amount. My common stockholders won't get anything. So since they get 40,000 shares, now I owe them $5,000. And because I owe them this $5,000 here, we get to the next year, year 3, how much do we owe them? We owe them another $30,000. So since we owe them another $30,000, the total amount that we owe them now is $35,000. Well, we're going to pay out $80,000 this year, right? So this $80,000 can now be split because my preferred stockholders are going to get $35,000 of this money. And the common stockholders will get what's left over. So that's why we've gotten 0 the first 2 years, is there was nothing left over. Well, this year we have the 85 minus the 35, or the 80,000 minus the 35,000, and that means that my common stockholders this year can actually receive $45,000. Now, the other thing that's on your worksheet is, well, how much are they getting per share? And if you go back and look at your worksheet, there were 3,000 shares of preferred stock, and then there were 10,000 shares of common stock. So what I would do here is I would go in and I would take the $15,000 amount, divide it by the number of shares, which are 3,000, and that is going to give me $5 per share. I would do the same thing at the 40,000. I would take the 40,000, divide it by the 3,000 shares that I have right here, and that's going to give me $13.33. For the last year, I take the 35,000, divide it by the 3,000, and I would get $11.67 as far as my per share price. Now, for my common stockholders, if they don't receive anything, then they get 0 per share. 0 per share. For that last one, what I would do is I would take the $45,000 that they received, divide it by the total number of shares for common stock, which was 10,000, and that's going to give me $4.50 is actually what they would receive per share. So each shareholder would receive $4.50 per share for common stock. So this is looking at, remember, the cumulative method. This is where we have to accumulate, and they will get paid their money as far as preferred stockholders go before the common stockholders can get anything. The other side of this is that non-cumulative. Now, non-cumulative is a whole lot easier to figure out because we're not trying to keep track of what the preferred stockholders are owed. We don't have to keep track of an arrears amount for this. So we just look at, year 1, we look at year 2, we look at year 3, and year 1 was 15,000 again, 40,000, we had 80,000. And remember, our preferred stock dividend is still going to be that $30,000 amount. So what we look at here is how much are we getting? Well, we're only paying out 15. These guys are due 30, so they're going to get the full 15 because we didn't pay enough out to pay them. So my preferred stockholders get 15. My common stockholders are not going to get anything. The next year comes along, we're paying out 40,000. Well, my preferred stockholders are due 30,000. So that leaves 10,000 for my common stockholders because 40,000 minus 30,000 equals 10,000. The next year I pay out 80,000. 30,000 is what's due to my preferred stockholders, and so my common stockholders are going to get $50,000. In figuring out the dividend per share, I do it the same way. I had 3,000 here, so 15,000 divided by 3,000 gives me $5. 30,000 divided by 3,000 gives me $10. And 30,000 divided by 3,000 gives me $10 here. So I would have $5, $10, and $10. For common stock, I have 10,000 shares. So for the first one, 0 divided by is 0. 10,000 divided by 10,000 is simply going to be $1. 50,000 divided by 10,000 will be $5. So that is what I'm going to be looking at whenever I look at these non-cumulative dividends. Again, non-cumulative is a lot easier because I don't have to keep track of what was actually owed. I just know that the preferred stockholders are going to get the first 30,000 of dividends every year. If I don't pay out 30,000, then they get whatever is being paid out. When I look at the cumulative, however, they're owed 30,000 every year, so I have to keep track of the amount that is in arrears and add it to what they're owed for the current year. And I do that every time period until I get to a place where they don't have any money in arrears and they're just getting their $30,000. So those are some of the things to look at as far as this dividend worksheet goes. Go through, work the dividend worksheet yourself. Go through it, of course, with me, with this video, but then go through and try to work the worksheet by yourself. I will have posted a answer key as well, but there's the answer key in the video, so you can look at it. If there's anything you're not understanding, then you can move back to the video and scroll back through to see exactly why you missed something or where you went wrong. So do that in studying for that first test that you're going to have.